Have you ever stopped to wonder what actually happens to your money the moment it enters a bank? Most people believe their savings simply sit inside a vault, waiting until they decide to spend them. It feels safe, it feels simple, but the reality is far more fascinating. Behind every bank account, every debit card, every mortgage, and every loan is a financial system so powerful that it quietly influences the lives of hundreds of millions of Americans every single day. It decides who gets access to opportunity, who pays the highest price for borrowing, and how wealth moves through the largest economy on earth. Yet, despite using banks almost every day, very few people ever discover how this system truly works. The biggest secret isn't hidden inside a locked vault or behind armed security, it's hidden in plain sight. America's banking industry isn't simply a place where money is stored, it's a machine designed to keep money moving. Every time someone buys a home, finances a car, starts a business, or even swipes a credit card, that machine begins working. Trillions of dollars flow through it every year, connecting families, businesses, investors, and governments in ways that most people never see. To the average customer, it's just another transaction. To the banking system, it's another piece of an enormous financial network that never sleeps. This isn't a story about villains or secret organizations controlling the world. The truth is both simpler and more surprising. Banks perform an essential role in modern economies. They help businesses grow, allow families to buy homes they couldn't otherwise afford, and provide the financial infrastructure that keeps everyday life running. But the same system that creates opportunity can also create debt, inequality, and financial pressure when it's misunderstood or misused. Understanding how banks work doesn't mean fearing them. It means learning the rules of a game that almost everyone is already playing. Over the next few minutes, we're going to follow the journey of a single dollar and uncover how one simple deposit can ripple through the economy in ways that seem almost impossible. We'll explore why banks earn billions even during difficult times, why debt has become one of the most profitable businesses in America, and why some people use this system to build wealth while others spend decades trying to escape it. By the end of this story, you won't just see your bank differently. You'll understand why the financial system has become one of the most powerful forces shaping the modern American dream. To understand how America's banking system became so powerful, we have to go back to a time when banks looked nothing like they do today. There were no mobile apps, no debit cards, and certainly no instant transfers. A bank was simply a place where people deposited gold or cash for safekeeping. The relationship was straightforward. Customers trusted the bank to protect their money, and in return, the bank charged small fees for its services. But over time, bankers noticed something remarkable. Almost nobody came to withdraw all of their money at once. Most deposits remained untouched for weeks, months, or even years. That observation changed the future of finance forever. Instead of letting deposits sit idle, banks realized they could lend a large portion of that money to people who needed it. A family could borrow to buy a home. An entrepreneur could borrow to open a factory. A farmer could borrow to purchase equipment before harvest. The bank earned interest on those loans while keeping enough reserves available for customers who needed access to their savings. It was a simple idea, but it transformed banks from secure storage facilities into engines of economic growth. The same dollar could support far more economic activity than anyone had imagined. As the United States grew into one of the world's largest economies, banks expanded alongside it. Railroads, factories, highways, office buildings, shopping centers, and entire neighborhoods were financed through borrowed money. Every major period of American expansion was powered, in part, by banks providing credit to businesses and consumers. Loans allowed people to spend tomorrow's income today, helping the economy grow faster than it otherwise could. Credit became one of the foundations of modern American life. But this new system also introduced a powerful trade-off. Borrowing made opportunity available to millions of people, yet it also created long-term financial obligations. Every mortgage meant years of monthly payments. Every business loan carried risk. Every credit card balance generated interest if it wasn't paid on time. The same system that could create prosperity could also create financial stress. Success depended not only on having access to money, but on understanding how borrowed money actually worked. Over the next few minutes, we're going to follow the journey of a single dollar and uncover how one simple deposit can ripple through the economy in ways that seem almost impossible. We'll explore why banks earn billions even during difficult times, why debt has become one of the most profitable businesses in America, and why some people use this system to build wealth while others spend decades trying to escape it. By the end of this story, you won't just see your bank differently. You'll understand why the financial system has become one of the most powerful forces shaping the modern American dream. To understand how America's banking system became so powerful, we have to go back to a time when banks looked nothing like they do today. There were no mobile apps, no debit cards, and certainly no instant transfers. A bank was simply a place where people deposited gold or cash for safekeeping. The relationship was straightforward. Customers trusted the bank to protect their money, and in return, the bank charged small fees for its services. But over time, bankers noticed something remarkable. Almost nobody came to withdraw all of their money at once. Most deposits remained untouched for weeks, months, or even years. That observation changed the future of finance forever. Instead of letting deposits sit idle, banks realized they could lend a large portion of that money to people who needed it. A family could borrow to buy a home. An entrepreneur could borrow to open a factory. A farmer could borrow to purchase equipment before harvest. The bank earned interest on those loans while keeping enough reserves available for customers who needed access to their savings. It was a simple idea, but it transformed banks from secure storage facilities into engines of economic growth. The same dollar could support far more economic activity than anyone had imagined. As the United States grew into one of the world's largest economies, banks expanded alongside it. Railroads, factories, highways, office buildings, shopping centers, and entire neighborhoods were financed through borrowed money. Every major period of American expansion was powered, in part, by banks providing credit to businesses and consumers. Loans allowed people to spend tomorrow's income today, helping the economy grow faster than it otherwise could. Credit became one of the foundations of modern American life. But this new system also introduced a powerful trade-off. Borrowing made opportunity available to millions of people, yet it also created long-term financial obligations. Every mortgage meant years of monthly payments. Every business loan carried risk. Every credit card balance generated interest if it wasn't paid on time. The same system that could create prosperity could also create financial stress. Success depended not only on having access to money, but on understanding how borrowed money actually worked. Today, the American banking industry manages assets worth tens of trillions of dollars and supports nearly every part of the nation's economy. Whether someone is buying their first home, launching a startup, financing a university education, or investing in a growing company, banks are usually involved somewhere along the journey. Yet, despite their enormous influence, one question remains unanswered. If banks lend out money that people deposit, where does all the extra money in the economy come from? The answer is one of the most fascinating ideas in modern finance, and it's the secret that surprises almost everyone the first time they hear it. At first, the idea sounds almost unbelievable. If you deposit $1,000 into a bank, most people imagine that exact $1,000 simply waits in a digital account until it's withdrawn. But modern banking doesn't work like a giant warehouse filled with labeled piles of cash. Instead, banks use deposits to support new lending while maintaining the liquidity and capital required by banking regulations. That lending, combined with the broader banking system, helps expand the amount of money circulating throughout the economy. Imagine Sarah deposits $1,000 into her bank account. A local business owner then qualifies for a loan and uses that money to buy new equipment. The company selling the equipment deposits the payment into another bank. That bank can then make additional loans to other qualified borrowers. The process continues across the financial system, allowing the same original deposit to support multiple rounds of economic activity. This is one of the reasons economists often describe banks as the financial heart of the economy. Money doesn't simply sit still, it keeps circulating, creating new opportunities with every transaction. This process is carefully regulated. Banks cannot create unlimited loans whenever they want. They must meet capital requirements, manage risk, maintain liquidity, and satisfy strict oversight from regulators. If they make too many risky loans or fail to manage their balance sheets responsibly, the consequences can be severe, not just for the bank, but for the wider economy. History has shown that when lending standards collapse, financial crises can follow, affecting millions of families who had nothing to do with the original decisions. So, why are banks willing to take these risks? The answer is surprisingly simple: interest. Every loan generates income over time. A mortgage can produce interest payments for decades. A business loan can generate returns while helping a company expand. Even a credit card balance that isn't paid in full can earn significant interest for the lender. When multiplied across millions of customers, those individual payments become billions of dollars in annual revenue. This is why banks pay such close attention to one thing: the flow of money. They're not focused on keeping cash locked away. Their business depends on moving money responsibly through the economy, connecting savers with borrowers, households with businesses, and today's capital with tomorrow's investment. When this system functions well, businesses hire more workers, families buy homes, and innovation accelerates. But when borrowing becomes excessive and debt grows faster than people's ability to repay it, the very engine that drives economic growth can begin to create financial pressure instead of prosperity. And that's where the story takes a dramatic turn. Because over the last few decades, one part of the banking business has become especially profitable. Not business loans, not mortgages, but something carried in almost every American's wallet: the credit card. That small piece of plastic would quietly transform consumer spending, household debt, and the profits of the banking industry in ways few people ever imagined. By the time most Americans reach adulthood, they already have a bank account, a debit card, and often their first credit card. It feels like a normal part of life. Swipe the card today, pay the bill later. On the surface, it seems incredibly convenient. But behind every swipe is a business model that has generated hundreds of billions of dollars over the years. The real product banks are selling isn't the plastic card, it's access to borrowed money. Imagine two people walk into the same store and each spends $1,000. The first person pays the entire balance before the due date. The second pays only the minimum amount every month. To the cashier, both customers look exactly the same, but to the bank, they are completely different. One transaction ends quickly. The other can continue generating interest for months, sometimes even years. And while millions of Americans focus on managing monthly payments, another group of people approaches the banking system very differently. Instead of paying banks large amounts of interest, they often position themselves to earn from the same financial system. That's where the gap between consumers and wealth builders begins to appear. The biggest difference between the average American and many wealthy individuals isn't simply income. It's how they think about debt, cash flow, and financial assets. Most people spend their lives working for money, using that income to pay bills, repay loans, and cover everyday expenses. Wealthy investors, on the other hand, often focus on acquiring assets that generate income over time. Instead of asking, "What can I buy?" they ask, "What can this money earn?" Imagine two neighbors receive the same annual bonus. One immediately upgrades to a newer car with higher monthly payments. The other invests the money into a diversified portfolio, a growing business, or a property that has the potential to produce future income. At first, the person with the new car appears more successful. Friends admire the upgrade, neighbors notice the luxury, and social media celebrates the lifestyle. But appearances can be misleading. 5 or 10 years later, the car has lost much of its value, while the investment may have grown, generated income, or appreciated significantly. One purchase consumed wealth, the other had the potential to create it. This is one of the most important lessons in finance. Banks understand the difference between assets and liabilities extremely well. Before approving a loan, they carefully evaluate whether an investment is likely to produce reliable cash flow and whether the borrower has the ability to repay. Every major lending decision is built around risk, future income, and long term sustainability. Ironically, many consumers make financial decisions based on emotion rather than those same principles. Another habit that separates experienced investors from the average borrower is patience. Modern advertising encourages immediate gratification: new phone, new car, bigger home, luxury holidays. Everything is marketed as something you deserve today, but wealth rarely grows overnight. It is usually built through years of consistent investing, disciplined saving, and allowing compound growth to do its work. The people who become financially independent often make decisions that seem ordinary in the present, but become extraordinary over time. Banks understand this better than almost anyone. They know that time is one of the most powerful forces in finance. The longer money remains invested or borrowed, the greater the impact of compounding. That's why a long-term mortgage can generate decades of interest payments, and it's also why long-term investing has historically rewarded patience. Time can either become your greatest financial ally or your most expensive enemy, depending on which side of the interest equation you stand. Perhaps the most surprising lesson is that the banking system itself is neither good nor bad. It is simply a tool. Like any powerful tool, its impact depends on how it is used. For someone who borrows responsibly to build a business or purchase a productive asset, it can accelerate financial progress. For someone who repeatedly borrows to finance consumption without a clear repayment plan, it can create years of financial pressure. The same system produces completely different outcomes depending on the decisions made by the individual using it. And then came the moment that reminded the entire world just how interconnected banks, markets, businesses, and ordinary families really are. A financial crisis that would expose both the incredible strength and the hidden fragility of the modern banking system. In 2008, the world witnessed something many people believed could never happen. Some of the largest financial institutions on the planet were suddenly fighting for survival. Home prices that had climbed for years began to collapse. Families lost their homes, businesses shut their doors, unemployment surged, and confidence in the financial system evaporated almost overnight. What started as a problem in one corner of the housing market quickly spread across the global economy, proving just how deeply connected modern banking had become. The crisis didn't happen because banks existed. It happened because, in many cases, risk was underestimated while the pursuit of profit accelerated. Large numbers of mortgages were issued to borrowers who were unlikely to repay them if economic conditions changed. Those mortgages were bundled into complex financial products and sold throughout the global financial system. As long as house prices kept rising, everything appeared stable. But when prices began to fall, that illusion disappeared. Loans that once looked safe suddenly became enormous liabilities. The lesson was both simple and painful. A banking system depends on one thing above all else: trust. People trust that their deposits will be available when needed. Businesses trust they can access credit to grow. Investors trust that financial institutions are managing risk responsibly. When that trust weakens, fear spreads faster than money ever could. History has shown that confidence is one of the most valuable assets any bank possesses, and once it's damaged, rebuilding it can take years. In the years that followed, regulators introduced stricter capital requirements, stronger stress tests, and tighter oversight to make the banking system more resilient. Banks today generally hold more capital and operate under more comprehensive supervision than they did before the crisis. These changes were designed to reduce risk and strengthen confidence, although no financial system can eliminate risk entirely. Every economy continues to face new challenges, from inflation and changing interest rates to technological disruption and geopolitical uncertainty. For ordinary Americans, however, the biggest lesson wasn't about complex financial products or regulatory reforms. It was about understanding that financial decisions made far away, in boardrooms, markets, and central institutions, can eventually reach kitchen tables across the country. A change in interest rates can affect a family's mortgage payment. A slowdown in lending can make it harder for a small business to expand. The banking system isn't separate from everyday life, it is woven into it. Perhaps that's the most remarkable truth of all. Every paycheck deposited, every loan approved, every investment made, and every home purchased becomes part of a much larger financial network. Most people never see that network, yet it quietly influences their opportunities, their costs, and their future. Understanding how it works doesn't guarantee wealth, but it does replace uncertainty with knowledge. And in finance, knowledge is often one of the most valuable assets a person can possess. The truth behind America's banking system is not a single hidden trick or a secret formula. The real secret is understanding that banks are not just places where money is stored. They are the engines that move capital through society. They connect people who have money with people who need money. They transform savings into businesses, ideas into companies, and dreams into reality. But like every powerful system, the outcome depends on how people interact with it. The same financial system can create completely different futures for different people. One person may use a loan to build a successful business, create jobs, and increase their wealth. Another person may use the same type of borrowing to finance a lifestyle they cannot afford and spend years trying to escape the payments. The difference is not the existence of the system. The difference is understanding the rules. For decades, financial education was treated like something optional. Many people learned how to earn money, but very few learned how money itself works. They learned how to get a job, but not how to build assets. They learned how to spend, but not how to make their money work for them. And that gap in knowledge created one of the biggest differences between those who struggle financially and those who build long-term wealth. Banks have teams of experts studying interest rates, risk, investments, and financial strategies every single day. They understand the power of time, compounding, and cash flow. The average person may never have access to the same resources, but they can still learn the same principles. Because the first step toward financial control is not having more money, it is understanding the money you already have. The $8 trillion story is ultimately not just about banks, it's about power. It's about knowing that every financial decision has consequences beyond today. A small purchase, a loan, an investment, or a habit repeated for years can completely change someone's financial future. Wealth is rarely created by one dramatic moment. More often, it is built through thousands of small decisions made consistently over time. The people who build wealth are not always the ones who earn the most. They are often the ones who understand the system better. They know when to borrow and when not to. They know the difference between looking wealthy and becoming wealthy. They understand that money is not just something to spend, it is a tool that can either create freedom or create pressure. So the next time you walk past a bank, look beyond the building, the advertisements, and the polish signs. Inside that building is a system that has helped create some of the greatest economic growth in history. It has funded inventions, supported businesses, and helped millions of people achieve goals they once thought impossible. But it has also reminded us of an important lesson. Money is powerful, but understanding money is even more powerful. Because in the modern world, the biggest financial advantage is not simply having more money than someone else. It is knowing how the game works. And once you understand the game, you stop being controlled by the system, and you start making smarter decisions inside it. But remember, financial freedom does not begin with having millions of dollars in your bank account. It begins with a decision to learn, a decision to understand, a decision to stop letting money control your life and start controlling the way you use money. Because the biggest difference between those who build wealth and those who stay trapped isn't always their salary, their background, or their opportunities. It's their knowledge. The financial world is changing every single day. New technologies, new markets, new opportunities, and new risks are appearing faster than ever before. The people who continue learning will always have an advantage. So ask yourself one final question. Are you simply using money every day, or are you learning how money works? Because the moment you understand the system, you stop making decisions based on fear, confusion, or pressure. You start making decisions based on knowledge. If this video helped you see money and banking from a completely different perspective, make sure to subscribe to the channel for more deep financial stories, hidden economic truths, and lessons that can help you understand the world of money. And if you found this valuable, share it with someone who needs to see it, because sometimes one new idea can completely change the way someone thinks about their financial future. This is not just about banks. This is about understanding the system. This is about building a smarter future. Thank you for watching. And remember, the person who understands money has a powerful advantage in a world built around money.